Okay, let's see what we do here. We're going to do problem 23 first, and we'll see how much, then we'll probably stop, take a break, and come back to problem 32. So, reading problem 23, you would have read that it is a acquisition with the acquired company, the investee, so to speak, is not going to continue as a separate entity. And so that means that, in essence, whether it's a statutory merger or any other kind of acquisition, when it's dissolving into the acquirer's books and records, that's it. That's all we need to say. It's going to dissolve into the acquirer, which means its assets and liabilities dissolve into the acquirer. It's like purchasing. If it was a statutory merger, it's the same thing as if they purchased the assets and liabilities. In this case, I think the problem says they actually purchased the liabilities or purchased the assets, and some liabilities come along with it. Sometimes liabilities don't come along with it. It all depends on the facts and circumstances. In this problem, they told you what they bought. So let's go and see what the solution looks like to see how you did. Okay. So in the first part of the problem, they paid cash of $700,000. Part of the problem was there's a contingent performance part of the price, meaning there's a contingency. Contingency means basically, just in case you didn't pick it up from class or the textbook, is that we will pay if the goal is reached. If, there's always an if. We will pay some additional amount if, and we call that the target, if the target is met, or a triggering event. Sometimes they call it a triggering event. You're going to owe me more money. You're going to owe me, in this case, $35,000 if the triggering event occurs. And the triggering event could be a certain amount of sales, certain customers stay on board. All kinds of things can be contingent and create this targeting or triggering event. And this happens a lot in business because maybe we don't know for sure if customers are going to stay, or we don't know for sure if certain things are going to work out that we valued. And because in the real world, a lot of the valuations are in ranges. And the ranges are based on, there's a range. It could be from 1,000, just as an example, all the way up to 2,000. Certain parts of the assets that are valued, or the company that's valued, could have a range. It could be in the assets themselves, or the company itself has this range, and it's based on an unknown. If certain things happen, it'll be worth more. If certain things don't happen, it'll be worth less, etc., etc. So that's why these contingencies are really part of the real world. You will see that more often than not in many, many acquisitions, particularly service firm acquisitions. It's more probable that you'll see it like in a sale of a service organization, consulting firm. Accounting practice is an example. Accounting practice will have as a contingency that the volume continues to hit certain goals for the next 2 years. That's a typical, the volume should be XXX for 2 years, and if so, then you get an additional amount, get the contingency, pay the contingency. So I just wanted to make sure you understood the real world concept of this, of what's going on. All kinds of sales of companies could use it. Depending on the circumstances, the buyer may be willing to pay more. The seller may want more, and the buyer say, well, I'll pay you more if I know certain things are going to happen. That's a good way to say it one more time. The seller wants more money than the buyer's willing to pay, and the seller says, why can't you pay the price I'm asking? Well, we think that something might happen. Okay, so if it doesn't happen, will you pay more? Okay, yeah, we would. So that's a contingency, and they put that in the contract. It's as simple as that sounds. It's not necessarily so simple to implement, but that's how simple it is. All right, so in these contingencies, what happens, and the problem gives you the information, so this course is not a valuation course, otherwise we'd have to do it, but the problem tells you that what they did is they figured out what the present value of the contingency is worth, meaning they took into account the likelihood of the triggering event occurring or meeting the contingency that's been put into the contract. They've put into there all the likelihoods, sort of like a statistician would do, doing probability analysis. So if they were going to pay, the true amount they're going to pay if things happen is $70K, but based on their evaluation of what this contingency is worth, they valued it at 35. But we don't know why. The problem doesn't tell us why. Again, this is not a course in valuation, so we're not going to spend time trying to figure that out. What I will tell you is another real-world issue, and that in the real world, unless the contingency is really something that's got some issues of whether it will happen or not, most of the time, and this is what I've seen from the Big Four, they're going to value the contingency at 100%. They're not going to take any present value discount like this problem did. So they'll value it 100%. So in this case, the contingency was $70K, and most of the Big Four probably would have just done that. All right, the problem takes a different approach and has a present value at 35. That's okay. We accept that value because we've been told that's what it is. Okay, now with all that gobbledygook of introduction, let's go and see what happens. Before I show you the actual answer, let me just say that the way it came out from the solutions from the textbook is the debits and credits aren't clear, so I'll make them clear as we go further along. All right, so the first thing we did is we come up with the fact that they're paying $700, check, $35,000 is the present value of the contingency, and that means that we're paying $735,000 for something that turns out that the net fair value, or the fair value of the net assets acquired after looking at the problem, is $750. So we're getting a bargain purchase here. Yay. Okay, that should be interesting to see how that gets journalized, and here's how the journal entries work. We bought receivables. What were they worth? $90,000. The problem tells us that. We bought inventory. What was it worth? $75,000. The problem tells us that. So I'm not making these numbers up. The problem gives us the fair value. Copyrights. The fair value here was different than the book value, and they tell you what the fair value is, and it's $480. That's what they paid for. These are all debits. This is a debit. And this is the patented technology. Again, the problem told us that that was valued, and it's actually different. It's lower than the value on the books of the subsidiary, but that doesn't matter. We're just going to book it at $700 because this is what we paid for it. The research and development, that the problem told us is a research and development issue, asset, where it has not yet reached technical feasibility, but it has an appraisal to it. It has an appraisal. So we get to use it as an asset, and we do, because it has appraised value, and we're paying for it. We are paying for it. Current liabilities is what it is. It's what the books have. So this is also a debit. The current liabilities, of course, is a credit. The long-term liabilities, they had a different value than the books, but so we use the value in the purchase price, the fair value. So that's $635. That's a credit. Now, the way it works with the contingency is it hasn't been paid in cash. This is a credit to cash, by the way, to pay for everything. Credit for cash. The investor paid this amount for these assets and liabilities, and of course they net out to the $750,000 we see here. That's where that $750 comes. And then the performance liability, the contingency, it hasn't been paid yet in cash. It will be paid if they meet it. So that's a liability at the moment, and that's a credit. Here's the gain on bargain purchase. You were expecting that, and that has to be a credit also because it's a gain, and it balances the entry. You would find that the entry now balances. So again, the couple of the nuances are to know that even though that we add into the purchase price the contingency amount, we add it in evaluating whether we have goodwill or, in this case, a bargain purchase, which we do. It's a liability because it hasn't been paid yet. It will be paid. If we're booking everything as if it was going to be paid at $735,000. That's why we credited the gain on bargain purchase. And so this has to be booked as a liability. Now, it may come out next year that they don't meet the performance triggering event, And so the result will be this doesn't get paid. If this doesn't get paid, what will happen then is that we will debit the liability for $35,000 and we'll credit some asset that it was related to, that this contingency was related to. Probably will credit, maybe we would credit, actually I think what we would do is just credit another bargain purchase, because we bought essentially what is worth $750. We know that, so it won't be an asset, it'll really be an additional amount to the bargain purchase at that point, another gain. And why would that be? Is because, go back to here, let's go back. If instead of paying $735 they only paid $700, they're still getting $750 the day of acquisition. The gain here would have been $50. So now, breaking it down into two pieces, one, this year they recognize a gain of $15. Then next year they don't meet the requirements to have to owe the $35. The performance contingency is not met, and zeros due. So now the bargain purchase needs to be credited at $35,000 more to make the total bargain purchase $50, which is in reality what happened. Okay, I hope you see that. One more thing, moving forward to the second part of Part A, which is the professional expenses this is a credit and this is a debit. I told you they're mixed up. The underwriting expense, or they call it the $100,000 paid to an investment banking firm, has to be expensed because the problem says they paid cash. There was no stock issue. If there's no stock issued, then we don't have that interesting nuance where we debit the retained earnings, or not the retained earnings, the APIC, the additional paid in capital. We don't have to do that because this can't be related to stock certificates or stock registration, because they paid cash. So whatever these expenses were for to this investment banking, it's an expense. Again, if you're not clear that, let me know and I'll embellish upon it, but I'm trying to make it clear here. All right, the next part of the problem, which is part B, they paid $800,000. Everything else remains the same. There is still the contingency of $35, so the total price at that point is valued at $835. This doesn't change, and now we've got a goodwill amount of $85. So everything else remains the same except with no bargain purchase, but we add $85,000 of goodwill. That's obviously a debit, and that's the entry. The entry is on the books of the acquirer in the acquisition, recording what they paid and what they bought, line by line. Some of the things they bought came with liabilities, so they booked those liabilities. And here they paid the $800,000 cash, and of course that's a credit. The professional expense entry doesn't change, that remains the same, under the same theory that I described before, that there's no stock, so we don't have any exception. This is all expenses related to the actual purchase as opposed to stock certificates or registration. Now, in this case, what if the performance liability wasn't paid the next year? What happens then? So that brings up the same idea as we had before. In this case, we'll debit the liability for $35, and now we've got a credit. In this case, the credit is going to be, that's such a great question. You should stop the tape and see if you can figure that out, if you didn't already figure it out with the problem. All right, I assume you stopped the tape and you're back, so the credit would be to goodwill, and it makes so much sense because if the credit's to goodwill, look what happened. In reality, here we booked $85 to goodwill. Why? Because our price was $835. The value of the net identified fair value of assets and liabilities netted to this number. That's the net fair value. So it leaves $85 goodwill between these two numbers, $835, $750 over here. But the windup is we only paid $800. We didn't pay the additional $35. In reality, that's what happened. So when that happens, now we have to say the goodwill was really only the difference between $800 and the $750. $50,000, and so between the 2 years, the debits and credits to goodwill make it come out. Here's a debit to goodwill in the first year, corresponding to that debit. In the second year, we credit goodwill for $35, net 50 goodwill at the end of the day. That's the way it should work out. Okay, I'll come back with another one on the second problem.